mentioned before we started recording that you've decided to go, instead of wide, going deep and really focus on the Phoenix market.
We're seeing more foreclosures. Insurance rates have dropped. Interest rates have also dropped a hair, and sellers' expectations are more in line to what the market can actually bear. So all those reasons make Phoenix continues to be a great market.
We worry about overbuilding of multifamily assets when we own multifamily assets, because then you can't charge as high a rent and there's absorption issues. But if you have in-growth of industry, that's tremendously beneficial to a particular market.
My personal goal is I want to teach the financially illiterate. I feel like America is in a bad position. Our school system is not teaching our kids money skills. It's teaching them how to be employees. Nothing against employees. If God made you for that, praise God, do it.
Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Caleb Johnston. Caleb's been on the show before. He's the managing principal at Red Sea Capital, focuses on acquiring and improving value-add apartment communities. Caleb, I as I said before we started recording, super excited to have you back on the show. Thank you for being here. Thank you for being back here, I guess I should say. Very excited to catch up and kind of hear about what you've been up to.
Yeah, thanks for having me, Jason. I'm really excited to be here.
Absolutely. Well, folks listening, certainly go back and listen to Caleb's other episode. But Caleb, give us a bit of a rundown of kind of where you come from, what brought you to where you are today, and we'll certainly do some chatting about what's changed since the last time we talked.
Yeah. It's been a couple years, but a high level, my background is I come from restaurant management. I was in that space for 5 years. At that position is when I started acquiring rental properties. My whole goal was I wanted financial freedom, and I wanted to become a full-time real estate investor. So I started house hacking, did that for about 3 years. Always thought I'd go bigger into larger commercial properties, but just felt like that was always out of reach for me. I didn't have enough money, or I figured I needed more experience in real estate to then play with the big boys. Then found a mentor that really opened my eyes and showed me that it was possible to start acquiring large deals at the point at the position I was currently in. And that's what I've done for the last 5 years, is focused on commercial multifamily. We do have one retail asset, but we have acquired 8 commercial assets over the last 5 years. And founded Red Sea Capital Group in 2023, and then Houses to High Rises, which is a step-by-step program that teaches people how to scale into multifamily and raise capital and underwrite deals and find good off-market opportunities. And we're actively buying. So in Phoenix specifically, we're obviously we have our current assets that we've acquired, and they're just in stabilization mode and just chugging right along, waiting for the right time to sell, like everybody else. But that's what our current business looks like.
Awesome. So, like I said, one of the things I think is always interesting to hear about, we've had a lot of market changes in the last couple of years. You mentioned before we started recording that you've decided to go, instead of wide, going deep and really focus on the Phoenix market. I have 2 questions about that, and answer them in kind of whatever order you think makes sense. But one is why Phoenix, and the other one is why that strategy. Why go deep instead of staying wide like you had before? What changed in your mindset on that?
Wow, that's there's a lot to unpack with that. But for me, how I started in commercial was I bird dogged and found deals for somebody that could sign on the loan and could raise the capital. That's how I got my feet wet. And then I probably did 4 or so deals like that. One of those deals I was the lead operator, but after those 4 or 5 deals is when I started raising capital. Even though we're still actively in those deals legally I can't just raise money and then
Right.
move on to the next thing. But bird dog deals, then raised capital. But what those actually doing that and getting the reps and what that showed me was if I really want financial freedom, if I want real estate to pay my bills, I need to have more ownership. I can't go wide. It's not sustainable. It doesn't work for me because I am a full time real estate investor, so I have to buy deals. They need to be cash flowing. So uh, that is why I've not gone wide anymore, and I've gone deep. And I can go deep. Our team can go deep because we have the experience, we have the track record, and frankly, Jason also has some deals that since I have not been the lead, I have not had as much control as I would want, and those deals haven't performed, or not just performed, but it's uh, I've just been in partnerships that I have not liked, I guess is the best way to say that. So now it's all right. I don't want to. I want to be the one person that when an investor calls me and says, "Why is this like? What's going on with my investment?" I can give them a straight answer. When I'm not that lead person, I have to make a call or search for that information. I don't want to do that. I want to be solely responsible. I want to know everything that's going on, and I want to be the determining factor to say this is we're doing this because of such and such reason. So that's and uh, to answer your question on why we've gone deep in Phoenix. I live in Phoenix, and it's very well positioned right now as we're doing this recording December of 2025. There are several hundreds of millions of dollars of loans coming due from operators that acquired properties in 2022, 2021, 2023, and they bought high, and now it's going to be a cash in refinance to even just stabilize, just to get out of that those loans. So we're seeing more foreclosures. Insurance rates have dropped. Interest rates have also dropped a hair, and sellers' expectations are more in line to what the market can actually bear. So all those reasons make Phoenix, well, at least the timing well, and Phoenix continues to be a great market with job growth and high-paying jobs as well.
Yeah. Yeah, I think the I guess the distress on the horizon. It's been an interesting time because the distress on the horizon has been something that's been talked about. I mean, we're coming up on 3 years for in a sense, what people talking about, all these, and there has been some what is it, pretend and extend, or there's all these things that people say about how to keep going, but the I think the reality is that some of the forgiveness, the cooperation, the modification of some of the loans that was happening is no longer as readily available as it was before, and so and people. I think there's also some level of fatigue, right? It's a lot harder to manage a distressed asset than it is to manage one that's comfortably chugging along and even throwing off a little bit of cash flow. So I think that a lot of those things are starting to come into play and be a very real part of the market. And so, you mentioned interest rates and insurance rates and all of that. The big thing is going to be, we had a time where there was a real stalemate between buyers and sellers, and I think that's now sellers are ready to let go. And so you mentioned some of the specifics to Phoenix, and I agree with you. I think Phoenix is it's a great market in that it's this is me talking. I like the size. I like the large cities with room to grow, because you can bring in industry and jobs and things like that to help support the housing that's there. Because there's sort of two things that happen from a supply and demand standpoint. We worry about overbuilding of multifamily assets when we own multifamily assets, because then you can't charge as high a rent and there's absorption issues. But if you have ingrowth of industry, that's tremendously beneficial to a particular market. So I think Phoenix sort of provides for both. They had a lot of building. I think that has slowed down a fair bit. So now we're going to start to, swing the pendulum in the other direction. So I agree with you. I think it's a great market. You mentioned that you're now vertically integrated. Talk to me about that a little bit. Like, when did you make that decision? How did that work for you? How did you kind of roll that out after over time?
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Well, two things. The first was, I've wanted to make this decision. Well, I've wanted this for a while, and I've learned that no one cares for your property like you do. And having property managers, and there's good property managers and there's also bad property managers. So me saying these things is not saying all property managers are bad, and it's just you should never have a property manager. I think every situation calls for a different approach, right? There's so many nuances. For me, I felt that, well, with my experience of asset management for several years and seeing how these properties manage and managing my own rental portfolio here in Phoenix, I realized there's so many inefficiencies with having a third-party property manager, that I can't control, and I'm at the property manager's whim. So that's and also it's alignment of interest with our investors. So that was all the why, and what allowed us to actually make that decision was, funny enough, I got married.
Congratulations.
And thank you. Yeah, I got married 9 months ago, and she comes from Wall Street. She also comes from PE in real estate, and she has this entrepreneurship drive to her. So I absolutely married an incredible woman, and she wanted to take on that property management. While I can find the deals and investor relations, she can focus on the operations side.
Nice. Well, that's convenient. Get in-house, literally, property management. So that's pretty great. Yeah, I think. Well, I mean, unique that you married that skill set, but it's an important piece of the puzzle, right? Like, you have to have the right skill sets. You have to have the right complementary skill sets within the whatever the business structure is, the partnership. I think you mentioned you have a partner or someone on who's a GC. So you have, in order to take on some of those things, you have to have someone who's actually going to be able to do it well. And I think that's it speaks to, you mentioned kind of the differing situations, and sometimes it's very reasonable to have third-party property management. Sometimes it makes sense to bring it in-house. People talk about this magic number, but then I've talked to a number of investors who bring property management in-house pretty early, and then some that have large portfolios and use entirely third-party property management. So it's it's not one size fits all. So that's great that you've been able to do that. How does that? I mean, how has that changed things for you? You just feel, you mentioned the word control before. Do you just feel like you're more in control of the assets? You have the ability to um, get very, sort of in the weeds as to what's going to work and not work?
Yeah, here's a good example is when I go hire a third party property manager, I can tell them, hey, get 3 bids for such and such, and let me know what you find. They, this property manager manages other assets, so they have other things to do, and so my request might get put. It's not at the highest priority, right? And so then they get busy doing their thing, and let's say in a week we touch base, and they've sent 3 emails out, but that was yesterday, right? Like, so they've had a week to do it, but the day before is when they actually made that outreach, and it was a simple email. Compared to me, let's say we're trying to get bids for trash, a trash provider. For us, if we realize, hey, we need trash, we will do a quick search on all the trash providers around us. We'll call all of them directly, and then we'll pit them all against each other. So let them get into this bidding war. We can say, hey, Waste Management gave us this price per month. Sierra Trash, what can you do? Right? And if they're like, hey, I can't help you with that, then we know this is the lowest we can go. And then so we can get into this deeper negotiation. And when you're talking about a portfolio of assets and you can do that, the savings is tremendous. And that's just one line item.
Right.
When we start talking about landscaping, pest control, GCs, so subcontractors, handymen, all of those things that we have more control over that. And it all comes down to, and no addition, not calling any property managers out. That's how the system works. That's their job. They need to manage several assets, and I get that.
Yep.
But for us, when we're more hands-on, we can control that.
Yeah. Yeah. I completely agree in terms of that level of detail to specific things. I think the other, and I'm like, this is always such a hard thing because frankly I think property management, the job, is extremely difficult. Like being the on-site property manager is a job that I would not want. I don't envy it. It's being an asset manager is different than that. Being that on-site person that's the face to face with the residents and there every day. It's a hard job. But a property management company, then there's always management fees that are essentially a percentage of collected rents. But I don't think it adequately aligns incentives there because it's the difference in collected rents, the difference to the property owner and the property revenue is much bigger than it is to the property management fee, in the sense that in actual dollars. So I think I don't love it is the normal it is the normal compensation structure for property management, but I don't like it. I don't think it actually aligns interests between ownership and third party property management. But that's an aside. So as you're staying deep in Phoenix, you think that the opportunity for growth there is great for a number of reasons, as you've described. What do you see as your focus, kind of over the next, say, 2 to 5 years? What are you really looking for? Do you have? I think you mentioned you recently bought something that was a little bit smaller, but also have larger deals. Like I'm just kind of trying to get a picture of what your buy box is, or maybe it's just Phoenix and you're looking for opportunistic assets, which I think is great strategy too. But tell us a little bit about like kind of what you're really focused on.
Well, we're really focused on, our goal in the next 2 years is to acquire one deal a quarter. And that deal size from 30 to 100 units. Um, that helps us stay out of the institutional players.
Yep.
And we'd even go as low as a C minus location. And vintage doesn't matter. So we can get creative, and we just looked at a deal that was used to be an assisted living facility, vacant since COVID. So you can imagine what that looks like. And he has to sell because the owner is getting a divorce. He has to liquidate. He has to. So so the price was 10.5. We're getting it for 6.5.
Great.
That's the type of deals that we're looking for, but it just comes down to distress in the market, and that's again the size that we're looking for. We're really focused on the Phoenix market, and since we're only focused on one location, whenever I'm an acquisitions guy, so when I start going to a market and I want to look for deals, I get low hanging fruit first. So I go to LoopNet and Crexy. I get all the brokers' information. I call them all up. So now I've got my brokers list, and the top, let's say 20% of performers, I'm going to call every 3 weeks just to see what's new in their pipeline. That's me going deep. But and it's unique in this market because now what I can also do is, because there's all these pre-foreclosures coming up, is that banks are having to take these deals back. So one approach we're taking is calling banks directly that own notes of multifamily properties that are in that buy box and building a relationship with them. Just giving them our information, what our approach is, what our strategy is, and it positions ourselves to say, it helps us accomplish two things. One is we can get these great deals straight from the lender, and I can pitch it to the lender and say, there's no broker's fees. I'm not a broker. I'm a buyer. So you get to save some money on your books as well. Now, if it comes to the point where a lender is having this situation, the seller or the owner is not paying their payments, or the bank's going to take it back. If the deal doesn't work for us, I can connect that bank with a broker that I want to get more deals from. And now I just brought that broker a smoking hot deal if the deal doesn't work for us. So now when that broker does get a really great deal, I'm going to be one of the first person they think of. So going to the banks directly is also how we're approaching the acquisition side of things.
Yeah, that's very smart. And it is very much a relationship-driven business, and it's funny. People, the people that have classes, I don't want to say gurus because mentorship programs.
I call them gurus.
Yeah, the idea. I feel like that has a bad connotation. They're not all bad, but basically people that are helping others learn this business talk so much about it being a relationship and network type of business, and it's really very true. And I think that's to me that's the main skill of someone like yourself in an acquisitions role, is just basically being able to make these connections, and where you're, as you just described, sometimes you might not get a deal out of it, but you're providing value to one of these other parties, and just it's such an underrated thing, but just being easy to work with, like being someone that other people want to work with, I think is such a huge advantage over time. It matters maybe more so in down markets, kind of like we are now, in the sense that there's not as much to go around. Maybe matters a little bit less when you're in that 2021 chaos that was going on. It was just people are transacting every day. But I think it shows staying power over time, just being in that position and making those connections. The banks, I think probably some people, when they're listening and they hear that, they think that you're going into Bank of America or Wells Fargo or something like that. And I'm guessing that that's not the case, right? And what you find out when you get into this world is that most of the loans don't actually go through those banks. They're not typically involved in like syndication type loans and in that particular, especially probably in that particular range. What when you say that, maybe let people know a little bit about kind of how you're finding these banks, what the maybe how they're structured a little bit.
Yeah. So how we're finding these banks is I can go to my county's Maricopa County. The county assessor site is where you're going to go. So if you're in any market, go to the county assessor site. But in Phoenix, right, I go to Maricopa County assessor site. I look up, well, first of all, I need a list of properties. So I can use like PropStream. Crexy even has a function like this. It's paid, but PropStream is $100 for a month. But they even give 7-day trials. You can go in there for free for 7 days, pull a list. Let's say all the properties in Phoenix. So now I've got all the addresses of these apartment complexes. I plug that into the county assessor site. It shows me the owner. Usually it's an LLC. So now I'm going to take that address or that LLC name. I'm going to go to the recorder's office. I can type in 123 Main Street LLC into the recorder's office, and then I can see the deed of trust. Now, the deed of trust is a document that shows essentially who holds first position, who's the lien holder of that asset, and it's going to be a bank, typically. So I can see the bank name right there of the bank that actually owns this asset. Because if you think, you drive down the road, you find a credit union. If you walk in there, what's the likelihood that they actually own a multifamily note? I mean, multifamily might not even be their preferred asset to hold or lend on. So when we use this approach, we can go straight to the source, and I know this lender holds the note for this asset. And it's a lot of calls. It's just a matter of if you can find a way to get that list in a time-efficient way, then make those calls and just make those introductions. But that's how we actually find those banks.
Yeah. Well, and to further that point, you said, if you just go into a credit union, they may or may not even lend on multifamily assets. But if you do what you're doing and you find the bank that has a note for a multifamily asset, they probably don't have just one. And so now you've kind of found that door in, and you can make connections and do exactly what you're good at. It just continue to make those connections and have, maybe it's not that one. Maybe that's not the one that ends up being the deal that you get, but you have now the connections at a bank that lends on multifamily assets in Phoenix. And so that, you get, this is what networking and building these relationships, that's really the goal, is like, you probably won't hit on every single one. You're probably unlikely to hit even on the majority of them, but you are building that net, if you will, to be in their minds when the right one comes up. So I think it's often talked about, but maybe not often described, like exactly how to go about it and what do you think your success rate is when you're going down that road? I mean, how I'm sure you have a bunch of different metrics to measure it, but how do you look at that? I guess that's a better way to ask. How do you look at success in those things and your ability to find good deals?
Well, it's what I tell people is focus on the lead measure, not the lag measure.
Yeah.
So What I mean by that is I'm going to I can only, Matthew 6:34 says you can only worry about today, right? I don't know what's going to happen tomorrow. So focus on today. It's got enough worries of today. So what I know is I got today to do. What am I going to do today to move my goal? And a lead measure is something I can control. I can control how many hours I spend going on Crexy and LoopNet and pulling a list. I can control how many broker calls I make. I technically can't control how many deals I underwrite because it depends on how many brokers send me deals.
Right.
But the lead measure is my output. But if I know in general, if I put enough output out, I'm going to get something back eventually. So what I focus on is the lead measure. What can I put out? And then the lag will take care of itself.
Yeah, no, that's a great point. I would imagine it's a bit of a snowball sort of thing where that, the amount of work that you're putting out, especially if you're staying particular to a specific market, right? You're in Phoenix, you're in a specific asset class in a specific size range. Like now at some point you effectively could know every building and that's in that, in that range. You can know every broker that works in that range, that kind of thing. So you can start to build that to a point where you've created such a net that it's like the only way carry the analogy, but the only way through that net is to you, right? It's like there's got to be, you're the person that's that they're going to think of in all instances. So I mean, I think it's a really smart strategy, Caleb. I think that's that's the idea. That's if you're doing this type of outreach, this is kind of the measures you want to put in place.
Mm-hmm. Absolutely.
What do you see for the your future in the business over the next couple of years? What are your goals at? You said closing every quarter. Do you have, again, I guess we'd be looking at a lag measure, but do you have an idea of unit count you'd like to get to, or maybe that's not the measure that you're looking at, but do you have goals that you're shooting for with that approach?
Yeah. Full transparency, we're going for a certain net worth, right? For us personally, like that's an internal goal that we're pursuing, and based on what we kind of bring to the table, meaning our ownership that we can have in these deals.
Yeah.
And to be even more specific with that, I like getting really specific because, you hear a guru on some podcast talk about, you go out and do this thing. It's like, okay, well, what do you mean by that? Like, let's dive deeper into that. What I mean by where we get that deal a quarter from is based on what we bring to the table. Meaning when you structure up a syndication, a GP deal, so general partnership, we typically own 30% of the pie. Investors get 70%. So for what we bring to the table, meaning when we can raise more capital, when we can find more deals, when we can do the asset management, when we can bring more capital to that, like at-risk capital to that deal, and also when we have a higher net worth and can sign on bigger loan amounts, we all get Red Sea Capital gets a bigger piece of the pie.
Right.
So that's what I mean by that when I say bring to the table. So with our skill set, what we can bring to the table, that gives us, let's say on average, a certain level of ownership, percentage of ownership. If I buy one deal a quarter, with that on average ownership, we can get to our net worth goal in 2 years. So when it comes to unit count, I think it's going to be easier for us to buy mid-size, like that 30 to 100 unit deal, compared to a bunch of 10 units. Like we need to buy 26 of those things to even make a dent, and there's not enough time in the day to buy 26 of them in 2 years, unless we change things. So we adopted a mentality of, I don't remember the book title, something about scaling. scaling your business maybe. But he talks about if you have a big BHAG, big, hairy, audacious goal. If all the listeners think of that right now, for us, let's say we want a $100 million net worth, just throwing a number out there. We want to get that in 30 years, right? It's okay. Well, what would you need to change if that's a 7-year goal? Was 30, now it's 7. You start thinking, oh my gosh, I got to do all these things and change this. Okay, what about a 3-year goal? What about a 1-year goal? You have to change everything, revolutionize what you're doing now. And it identifies so much of what we do makes us busy, makes us feel busy, makes us feel like we're productive. But if the BHAG is a BHAG, it's a BHAG for a reason. It's important for a reason. So why aren't we putting more effort into that today? Why is it a 30-year goal?
Right.
So that's kind of why we've taken that approach. And that's how we've come up with that one deal a quarter number.
Yeah, that's great. I think compressing your time, I forget what the principle is, but that we basically fill whatever amount of time we have to accomplish a task, we fill that time. So it's you could accomplish it as it's like the same thing, like you're describing. If you cut that task down to from 30 years to 7 years, you'll accomplish it. There's so many examples that you could use, but that's the idea, is that like that's human nature, is we tend to fill the amount of space we have to get something done. So if you put a restriction on the amount of time you have to get something, you just get it done faster. You get it, you figure out a way to get it done faster. So it makes a lot of sense. Very cool. Well, Caleb, let me shift gears. You were on before. I asked you, what is your why then? I do think that whys sometimes change over time. I've joked about changing the title of the podcast to The Evolution of Why, but I will ask you again, of course, what is your why? What's driving you these days? You've had some strategy shifts, but you got married, so there's some some things that have happened that could impact that. So tell us a bit about where you're at now.
Yeah, and I really appreciate that question, because so many times it's about the money. It's like, oh, I want to get a certain net worth. Oh, I want to make a certain amount of money. But at the end of the day, we don't want money. We want what money will give us, which is comfortability, control. So I love that question. For me personally, what motivates me whenever I think about it, I can just be on fire, is sharing the gospel. So what Christ did for us, dying on the cross. And I almost went into full-time ministry a couple of years ago, but God shut that down and opened up a business venture. So in business, my ministry is my business. And that why never ends, right? It's like uplifting people. That never ends. We want to have nonprofits where we can feed people in Central America, where my personal goal is I want to teach the financially illiterate. I feel like America is in a bad position. Our school system is not teaching our kids money skills. It's teaching them how to be employees.
Yeah.
Nothing against employees. If God made you for that, praise God, do it. But I feel like America should be doing a better job of preparing the next generation with financial literacy. So I want to start a nonprofit that helps with that. Maybe it even looks like a school, kind of similar to Robert Kiyosaki. He built that rat race game, the cash flow game. Mm-hmm. But that's the why, is sharing the gospel, but then also how do we just make the world a better place with these types of nonprofits?
Yeah, love it. Great. I do. I completely agree that the financial education is sorely lacking, unfortunately. Forget entrepreneurship, although that would be a great thing to be teaching in schools. It's just basic life skills, financial skills would be a good starting point. And then, as you said, we are generally taught to be employees, which, if that's what you want, awesome. But if that's not what you want, you probably weren't prepared otherwise. So I think just giving people optionality. Um, when people hear this and they want to reach out, what's the best way for them to connect with you?
Two things. One is LinkedIn. Search up Caleb Johnson. I'm also writing a book right now that should be launched in January called From Rentals to Apartment Complexes. If someone wants to learn more about literally how do you go deep in buying apartments, that book tells you. So LinkedIn is the best way to get in touch with me, but that book will also give you the skills you need to start making a dent in your goal to buy multifamily.
Awesome. Well, we'll get that stuff in the show notes. People can connect with you. Caleb, this was great. Thank you again for coming back on the show. I really appreciate it. I always appreciate guests' time to give it to me more than once. It is an honor. So thank you for being here. I'm excited to see what the future holds for you. I appreciate your time today.
Thanks for having me, Jason. I had a blast.
Folks listening, make sure you connect with Caleb. Please like, rate, and review the show so we can continue to get great guests. And as always, thank you very much for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?